The Bank of Canada has just announced its third hold in a row, maintaining its key policy interest rate at 2.75%.
This decision reflects three main considerations. First, uncertainty about U.S. tariffs on Canada is still high.
That's Bank of Canada Governor Tiff Macklem at his most recent news conference.
Second, while U.S. tariffs are disrupting trade, so far Canada's economy is showing some resilience. And third, inflation is close to our 2% target, but we see evidence of underlying inflation pressures.
As always, here to unpack this latest decision is Scotiabank's chief economist, Jean-François Perrault. He'll tell Armina Ligaya what it says about the state of the Canadian economy, where rates may head from here, what Canadians should take away from all this, and more. I'm Stephen Maurice, and this is Perspectives. Now here's Armina Ligaya.
Jeff, welcome back to the show.
Well, thank you.
So we're speaking about midday on Wednesday, July 30th, just a few hours after the Bank of Canada announced its latest decision to hold its key rate steady for the third consecutive time. So, Jeff, what is your main takeaway from today's decision?
Listen, the main takeaway is there's no surprise. I mean, they are in the same boat as everybody else, trying to understand where things are going, trying to understand the direction of U.S. policy and how that impacts Canada, trying to understand the balance between the pickup in inflation that we're observing versus a slowdown in growth that we're observing. And that's a challenge for them. That on balance is leaving them on hold, subject to lots of questions on their part about where things go from here.
Mm-hmm. Now, obviously, another hold was largely expected, but what we were all watching for is anything that we could learn from the commentary from Governor Tiff Macklem today. What can we glean from both the statements and some of his answers to the various questions?
I mean, I'd like to say that we learned a lot, but we didn't. We learned that he is in the same situation as he was last time around, which is trying to make sense of the operating environment for them, trying to understand, how bad are these downward pressures on growth. And we're, of course, know that they're not as negative as we thought they'd be. Growth is a little bit stronger, a little bit less weak than we anticipated. We know that inflation has been on the rise and that's the tug of war that the central bank has been dealing with. Mm-hmm. Is inflation more of a concern than growth or not? And at present, it does seem that the inflation dynamics are a little bit more of a concern as they were last time. And that's reflected in their decision today, I think.
I want to go back and unpack each of those different elements that would have contributed to this decision today. But was this the right call in your view?
We think so. I mean, we've been worried about, worried is a stronger word. We thought for many, many months now that the Bank of Canada would be on hold for the year. So this is in line with our thinking. And that's precisely the reason for that was, we were concerned that the way the uncertainty was playing out, the way the tariff shock was playing out, the way we retaliated, the way folks feared inflation would contribute to pick up in inflation. That would have been a challenge for the central bank to cut interest rates in. So that's occurring. It seems to be occurring. Now, that's not a great thing. I mean, it's good for our forecast, but when growth is weaker, you would like the central bank to come in and help a little bit. It's just constrained right now because of the nature of the shock that we're experiencing in Canada and the U.S. and elsewhere around the world.
Now, this is obviously an incredibly tough time for the Bank of Canada in particular to make a rate decision with the August 1st trade deadline looming. And like in April, they chose not to put out a forecast, but this time they came up with three different scenarios, a current scenario and two other alternate scenarios. Would you be able to walk our listeners through what they see as possible paths ahead?
Yeah. So as they try to figure out where the world is going, they've kind of foregone the traditional way of thinking about the outlook from their perspective, which is to publish a forecast and talk to that forecast in the monetary policy report and the communications. So the second monetary policy report in a row now where they do not publish a base case forecast. They say, these are the range of outcomes that are possible depending on what President Trump does on the tariff side. More tariffs, less tariff. And then their central scenario, the current policy scenario, which is what if what is in place now stays? And those three scenarios give you pretty significantly different outcomes, whether it's on the growth side or the inflation side, depending on tariffs strong or weak, depending on the uncertainty. So you get a range of outcomes, which, I guess you could say maybe they picked the current policies one as a rough base case, but they certainly won't speak of it as a base case. They say it's like, this is where things are now, but we know they're going to change. And here's some ways in which they can change. So in those scenarios, they don't tell us what their rate forecasts are associated with those, but it's very clear. One of the scenarios got significantly higher inflation. Presumably that's not a scenario where you cut. One of those has got inflation that declines, probably a scenario where you're more likely to cut. In fact, the governor talked about, if things work out great, we might be able to cut at some point in time. That's kind of reflective of this de-escalation on the tariff side. And the current scenario, which is what we're experiencing now, growth of slightly under 1.5% this year, according to them. We're at 1.5%. Inflation that has accelerated and remains a challenge. Of course, they're not commenting on the rate scenarios surrounding that, but they haven't moved yet. So presumably that's a scenario where they don't feel comfortable enough cutting interest rates as they go forward.
Do you have a sense of what of those scenarios is the most likely at this stage?
I'd love it for be the scenario where tariffs come down, but that doesn't seem to be a realistic scenario. More likely than not, the current policy scenario, so where we are now. Now, we know that's also not going to be the case. There is an upcoming deal supposed to be had between Canada and the U.S., which they're negotiating right now, possibly by August 1st. Looks like it might slip a little bit. The Prime Minister's already indicated there will be tariffs as part of that. It's not the de-escalating scenario world, but the current policy scenario doesn't strike us as a bad point of departure to think about the world in which we're operating.
And to put this in perspective, how unusual is it to be in that situation where you cannot make any forecast, that you have to have various scenarios, and even those, the probability of each is varied?
It's extremely unusual. I mean, part of the Bank of Canada's communications approach, of course, Bank of Canada's 2% inflation target, they go at pains to explain how they're going to get us back to 2% inflation when inflation is too high or too low. And, they do speeches about this, they publish reports, they do the monetary policy report. Everything is geared to helping us and you understand where the economy is going to go and where inflation goes. So for them to not publish a forecast is extremely unusual because it provides less clarity about the way forward on inflation, which is, of course, what we rely upon them to give us. So the fact that they have done this twice in a row is just an indication of how uncertain they view the world. And of course, we're living it as well. It is a bit exceptional also by virtue of the fact that, everybody else is publishing forecasts and they're going the route of scenarios as opposed to forecasts. There's a debate as to whether that's the right thing, but certainly from their perspective, they believe it's the right thing. And in so doing, maybe to some extent contribute a little bit to the uncertainty that's out there because they are telling Canadians that we're not sure we understand where things are going to go, and you shouldn't be sure either.
Maybe we can talk about what we do know. How is Canada's economy doing at this point in time? There seems to be a sense that it's been more resilient than expected, but then there was also a contraction in the economy in the second quarter. So give us a lay of the land.
That's what the governor thinks. The governor's articulated today that he thought the economy was going to decline in the second quarter. That's not clear. That's a forecast. Could be that it's flat. Irrespective, it's a weak economy. There's no question about it. The surprise has been that it's not been as weak as we thought. There's a bunch of reasons for that. Part of that is the way businesses in the U.S. and Canada managed the early days of the Trump administration by, shipping lots of goods back across the borders to accumulate inventory because you didn't know what the tariffs are going to be. That contributed some strength in the first quarter, created inventory accumulation in the first quarter. Some of that is going to unwind in the second quarter. So there's going to be weakness in the second quarter for sure. That being said, that weakness doesn't appear to be as dramatic as we'd feared. Some folks are out there thinking there's going to be a recession this year. A lot of folks earlier this year were saying there's going to be a recession in Canada. That doesn't seem to be a likely scenario any longer. And in fact, when we look at some housing market indicators, when we look at the job market, we look at some retail sales numbers, it's clear that consumers aren't pulling back nearly as much as we thought. It's clear that folks are re-engaging hesitantly in the housing market, but they're re-engaging after a period of some of the spring months where activity is very depressed because folks were extremely worried about the world that we're in. So we're finding out that households are perhaps less worried than they were earlier this year. Businesses are certainly less worried than they were earlier this year. And that's leading to a little bit of change in attitudes, I think, on the part of business and households, which is giving us a little bit more dynamism than otherwise would be the case. But that's occurring in the context of weak growth. As I said, we're expecting growth of about 1.5% this year, which is not zero. It's not a recession, but that is by no stretch of the imagination strong growth. That is well below potential output growth, so trend growth. That is a level of growth which, absent tariff, would be putting downward pressure on inflation, would be leading to higher unemployment rates, which we're seeing, except for this unbelievable June employment report. So it is an environment where the economy is not operating as strongly as it could. It's just not operating as weakly as we thought it might.
Let's talk about that incredible jobs report. Can we dig into the latest numbers and what that signals? We're
not sure what it signals because the numbers are so spectacular that you've got a legitimate question there. The economy is not strong. People were still worried in June. Why would firms all of a sudden hire almost 90,000 people? Now, a lot of that is part-time, but still, this broad-based increase in employment, wage growth moderating, but still pretty reasonable. And associated with that, a significant increase in hours. So hours worked is a key determinant of economic activity, right? The more hours people work, typically, the stronger economic activity is. So it's an outlier report for sure. We're not putting too much stock in that because it does not reconcile well with everything else we're seeing going on in the economy. But it is an economic reality that there were significant amounts of jobs created in June, which benefiting a broad range of industries across a broad range of provinces that do suggest that, again, things maybe aren't as dire as we thought they might be.
Well, which segments of the economy are feeling the tariff effects so far?
I mean, that's pretty straightforward. So when you look at the sectors of the economy that are most exposed to the U.S., of course, that's manufacturing. There's been a significant slowdown in employment, significant pickup in unemployment. So you see parts of the country like Windsor, for instance, with the unemployment rate around 11%. It's kind of the heart of the auto industry. Autos, unsurprisingly, were a target of President Trump's. Steel and aluminum producers having a hard time as well. So those sectors are struggling. There's no question about it. They're struggling, and you're seeing that in the employment outcomes, but you're seeing that in production, seeing a broad range of indicators related to those industries. But apart from that, there is seemingly relatively little harm done elsewhere. It's not a big surprise, but we just kind of, as Canadians, are focused on those sectors that are most impacted because they're very visible and they're close to our heart, forgetting for a moment that the Canadian economy is not just auto, steel, and aluminum, and the energy side. There's a much broader diversity to that. In fact, one of the ways in which we're seeing growth rebound or do pretty well is on the tourism side. Not so much because Americans are coming here or foreigners are coming elsewhere, but Canadians are traveling less internationally and they're spending more domestically. So it's been a pretty darn good summer so far for the tourism sector, surprisingly strong, given, again, the concerns that people had earlier this year that maybe they'll lose their jobs, maybe they should be more careful on the spending side. There's a willingness to spend.
So overall, still not ideal, but much better than we would have expected maybe 6 months ago.
Yeah, for most of the economy, that's the case. But again, for folks in the auto sector, folks in the aluminum sector, steel sector, these are hard times.
Let's talk about inflation. The latest inflation numbers showed an increase to 1.9%, but that's not necessarily reflecting the underlying elements of core inflation. Can you talk about what the inflation numbers are telling us now?
So the inflation numbers are really telling us that inflation is strengthening in some sense. True, the headline number is 1.9%. That's after the carbon tax elimination. When you strip out indirect taxes, of which the carbon tax is one of those, inflation accelerated around 2.5%. When you look at the Bank of Canada's preferred measures of inflation, a technical thing called CPI trim, the mean CPI, those are rising about a 3% rate, and that's been accelerating. So over the last several months, you've seen a trend to pick up in inflation, even though the headline number has looked better because you've taken out the carbon tax from a calculation perspective. When you look at measures of breadth of inflation, so the proportion of inflation components that are rising above 3%, above 4%, those have started to rise significantly in line with what happened during the pandemic, where you saw this broadening of inflationary pressures. So it does look at present that inflation pressures are broadening a little bit. And that's, of course, not great from the Bank of Canada perspective. It's not great for Canadians because, affordability is still a challenge. But it does point to the need for vigilance by the central bank. And that's, again, how they've been operating.
And what elements are driving it? Is it housing? It's
pretty broad-based. So, on a year-over-year perspective, shelter costs account for the majority of inflation that we're seeing. That's been the case for a long time. There's nothing new there. But what's occurring that's more worrisome is, and the governor spoke about this today, the non-energy goods side of the inflation basket has been picking up significantly as well. So a broadening, if you will, of those sources of inflation away from housing to things that are more directly related to trade or, your everyday purchases.
So with what we know now, you talked a little bit about your expectations in terms of rate decisions for the year. What are you expecting? Last time we spoke, you didn't expect any cuts for the year, but the Bank of Canada did seem to signal they're leaving the door open if needed. What is your outlook on that now?
We're still the same. We don't think they cut interest rates for at least the remainder of the year and possibly all of next year. Now, what will determine that is balance between inflation and growth. And I think that's what the governor's kind of trying to articulate, that we're trying to understand which is going to win out, inflation or growth in terms of inflation dynamics. And at present, they don't have enough information to be able to be confident that one side of that equation is going to win over the other. As we get more data, of course, that hopefully will evolve and they'll have more clarity and then maybe come back to regular forecasts as opposed to scenarios. But it is essentially a horse race between inflation and economic activity for the next few months. And so far, inflation is winning that race.
And what about the housing market? You touched on it a little bit, talking about shelter costs, but I'm seeing a lot of headlines that, rent prices are softening and housing prices in certain areas are softening. So those would-be homeowners are looking to see a cut. But what's happening on the ground in terms of housing?
I mean, of course, like every developer in the country, every home buyer in the country, every borrower in the country would like to see lower interest rates. There's no question about that. And the housing market has suffered. There's no question. House prices are lower than they were in 2022 for many markets across the country. The uncertainty of the early Trump tariffs or threats of tariffs against Canada really acted as a brake on the housing sector, which had started to rebound last year as rates have come down. So the last fall, the market was pretty solid. Even to early this year, we saw some pretty good sales activity that collapsed when people became more worried. And that's just now turning around. The reality is that there are still massive unmet housing needs for Canadians. Prices are still high, even though they come off a little bit. Affordability is still a major issue. But we know Canadians need housing. And it's just a matter of time from our perspective before those green shoots in the housing sector that we're seeing grow into something more substantial, given the needs that Canadians have, given the fact that now I think people understand that rates aren't necessarily going to go down that much further from where they were. So there's no real benefit of waiting another 6 months to get a much lower mortgage rate than you would have been the case, say, earlier this year. So the factors that might have, in addition to the uncertainty, that might have kept people offside for a little while are starting to erode a little bit as well. So we're seeing some momentum and hopefully it continues. But that's a question of psychology to some extent. How comfortable people are going to be if we get a deal with the Americans that's great or not in the next few days, next few weeks. How do we feel about our standing in the world?
So what are your main takeaways for Canadians from the Bank of Canada's decision today and their outlook?
The first and obvious takeaway is interest rates aren't about to be slashed. Bank of Canada is concerned about inflation, as we talked about, and growth. I know there are folks that are hoping for interest rates to come down. That doesn't seem to be very likely as we think about the next few months, next few quarters. They might come down a little bit at the margin, but not significantly. The second is this uncertainty is there, and it's impacting Canadians, and it's impacting growth. And as a result, we have weaker growth than we would like, but not as weaker growth as we feared. So that is, at the margin, a better thing. And then third, we haven't fully seen the impact of the policy developments to come on the fiscal side or the policy side from the federal government, the provincial governments. We haven't fully seen people kind of get accustomed to the trade environment from an uncertainty perspective, from a confidence perspective. And then there'll be lots more news on that front in the next several weeks, which will be impactful on the outlook. But hopefully, all that stuff leads to a bit of a better dynamic going into 2026 than we had certainly going into 2025.
That's a really good place to leave it. Thank you so much for coming on the show today.
Well, thanks, Armina.
I've been speaking with Jean-François Perrault, the chief economist at Scotiabank. The Perspectives podcast is made by me, Armina Lagaya, Stephen Maurice, and our producer, Andrew Norton. The clip you heard in the intro was from the Bank of Canada. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.